delighted to be here with you today, giving a EU direct tax policy update for H1 2024. My name is Sasha Cairns and I'm an international tax partner with Grant Thornton in Ireland. And I'm joined by my colleague and good friend, Monique Piesters, the recently appointed Head of Tax for Grant Thornton, Netherlands. Monique, what are we going to talk about today?
First, thank you for having me again, Sasha. It's lovely to do these international items with you. With the Belgian presidency coming to an end and the re-elections we will be having for the European Parliament and the European Commission in July, it's interesting to see what's on the agenda and what the outlook is. There are a lot of topics we could address, but what we will touch base on today is the UN. We will touch base on Pillar 1 and the Digital Services Tax, the HOT proposal and the FOSTA proposal, and the TP directive, and also a slight bit on DAC 6, and some other topics which we will not be discussing further today, but which are interesting to note, is the Unshell directive. It's interesting to see that it is still on the table and progress might be made soon, because there is a referral on the Unshell directive in FOSTA. And in line with that, of course, the SAFE directive for tax intermediaries. And also DEBRA and BFIT are still there, although they are on standstill at the moment. They are still closely to be watched. So it's interesting to see with the re-elections and the new Hungarian presidency what will happen next. But first, maybe a question to you, Sasha. So with the Framework Convention for Taxation, which has just been adopted by the UN, there is, some are afraid that the control might shift more from the OECD to the UN. What are your thoughts on that and the impact on that for member states?
Yeah, I think it's really, really interesting in the context of global tax, and maybe just to frame it, the background being that, you know, for the last 60 years, as we know, the OECD has driven global tax policy. And what happened last November was that the African group made a proposal, which was accepted by the UN, to develop a framework where the UN would get more involved in monitoring, but also helping develop global tax legislation. I suppose some of the reasons behind this is there's a feeling that international tax law is very much being driven by industrialised economies, and the voice of developing countries hasn't really been heard. Secondly, with the growth and the pace of change with globalisation and digitalisation, the pace of change of international tax law has been slow, even though we've seen a myriad of it in the last number of years. So it's interesting to see how this is going to move forward. The EU have a view around this, obviously, because as an EU group, but also as individual member states, that they're party to the UN. And the view is, you know, how quickly can this actually get adopted, given the ad hoc committee that sits at a UN level from a tax perspective. They're very much keen on hearing the views of other UN members around this. And I suppose the point is, there's a concern, and Benjamin Ankel did refer to this in a recent seminar in March, that, you know, they're very concerned that what happens at a US level or UN level doesn't derail any of the international work that's already been done on Pillar 2 and Pillar 1, because obviously they're at a very unique stage as to where they're at from the point of view of obviously implementation of Pillar 2 and where we are on Pillar 1, which we'll talk about in a few minutes. There are really concerns around that. From the point of view of next steps on the framework, what does that mean? Well, there was a meeting in New York recently. There's been an agreed roadmap for negotiation. There's a meeting due again in July, and they're hoping to have a draft terms of reference by August. Now, that's a really, really short framework. And there's been some commentary, and probably not everybody believes they can get there by August. And what we've seen, I suppose, in international tax generally is how long it takes and the consensus it takes. And obviously the UN members are much larger than the OECD. There's about 193, whereas the OECD level is about 140. So trying to get consensus on a draft framework by August of this year will be very, very challenging. So definitely a space to watch, from the point of view of the role the UN are going to look to take going forward in global tax policy to support developing countries and make sure their voice is heard.
Interesting. I heard you touch base already on Pillar 1. We know there's a big effort to also get Pillar 1 across the finish line. But in recent discussions, the EU has mentioned already that if Pillar 1 doesn't make it, they will come to some sort of digital services tax in the EU themselves. Well, there are, of course, already some countries who have introduced this already. So what are your thoughts on this and where this might go?
Well, interestingly, if, will Pillar 1 get over the line? We'll wait and see. I suppose, they were supposed to have draft text agreed or text agreed by March. They've missed that deadline. So again, that's open to interpretation. From an EU perspective, we have 10 member states who have digital service tax legislation. Not all of them have activated it. We've 2 member states who have proposals, and we've 4 who've indicated they would move to implement digital service tax. So more than 50% of EU member states are very much open to having a digital services tax structure within their own domestic legislation. The concern about digital services tax on a state-by-state basis is one, lack of consistency. So even if we look at digital services tax across the different EU member states, we can see that one, the scope of what's considered digital service taxes varies on a member state by member state basis. The thresholds as to what type of entity is in scope, both at a global revenue level, but also at a member state level, vary significantly across member states. And also the actual rate of digital services tax varies from about 1.5% to 7.5%. Right. So if we have digital services tax on a member state by member state basis, looking at the EU alone, we have a huge inconsistency for multinationals who are trying to navigate this, trying to make sure their systems can comply and trying to make sure they have the controls in place to capture this information accurately. And that's one of the challenges. The second challenge, obviously, that we're also aware of is that digital services tax is not considered an income for the double tax treaties. So therefore, this whole concept of potentially double taxation. And the idea around Pillar 1 is it was supposed to deal with a lot of those concerns that existed. We all know that Pillar 1 won't get over the line unless the US get behind it. Again, there was a recent presentation at US Treasury level in March, which said that the cost to the US, if we looked at 2021 data, would be about 1.4 billion for that year. So again, a lot of concerns as the impact it's going to have on US multinationals if Pillar 1 is adopted. But again, Pillar 1 won't get over the line and they won't get that 60% margin unless the US comes behind it. Some statistics that have been issued clearly show that if Pillar 1 is implemented, there's probably going to be a larger tax take for a lot of the EU member states under Pillar 1 than there is under their existing DST legislation. You take France, for example, their take was about 450 million based on the last piece of data. And it's estimated under Pillar 1, it would be about 600 million plus. So again, the benefits of a DST at a local level versus the wider Pillar 1 piece of legislation in discussion. You talked about them having a digital services tax across the EU. I think it's clear from the commentary from the EU Commission, they've moved away from that concept. They don't think it will make the EU a very business-friendly place to do business. We're obviously at a real tipping point here as to whether we get this over the line. There has been a situation, obviously, where DSTs, an agreement, DSTs new DSTs won't be rolled out by countries, but existing DSTs were due to be repealed under a transition process by June 2024. We're getting very close to that. That was obviously on the basis that Pillar 2 was enacted and we were moving forward. So again, we get Pillar 1 over the line, DSTs will be repealed. If we don't, there's obviously a number of EU member states sitting there that are likely to implement DSTs on a member state by member state basis.
Yeah. You mentioned 10 member states who implemented the digital services tax in the EU. Netherlands isn't one of them. Ireland also not?
No. And 6 of those states have actually activated them. Okay. So we've got 4 that have legislation that isn't actually activated. But no, Ireland is not yet there. But obviously, we have a concern from an Irish perspective, the impact it's going to have on our tax take as we move forward.
Okay.
So I think that they're really interesting content to talk about. But maybe moving forward onto FASTER, we've seen some recent changes around FASTER and how that's potentially going to be implemented and where we are going forward. Can you talk to us about that?
So what's interesting to note on FASTER is that the official text of FASTER has recently been agreed upon. Now it's up to the European Parliament to see whether it's officially adopted. But maybe good to give a little background on FASTER, what it is and what it does. So if you are an EU investor and you invest in a European company, and let's say that the company distributes a dividend, then of course withholding taxes can be imposed. based on double tax treaties or EU directives, subsequently, you can get a refund for this withholding taxes. But those are mostly very costly, time-consuming, and the refund procedures also vary per European country. Also, there's quite some fraud still with respect to refund procedures. So what the EU tried to do with this Foster proposal is make the refund procedure less costly, faster, and also combat abuse. And basically, this new Foster proposal contains of 3 key components. It concerns a tax residency certificate, which has to be issued by the member state in which the company is resident. And currently, it's been set at 14 days. So within 14 days, the member states should issue this residency certificate to the company. Subsequently, you can only deal with certified financial intermediaries, and those should register at the member state involved. And last but not least, the member states should implement one of the 2 alternatives. They should really insert a relief at source system. That means that they immediately apply the withholding tax rate, which should be applicable, or that they do a quick refund procedure. And the quick refund procedure basically means that within a certain amount of days, the taxpayer should get the refund of the withholding taxes. And the last text agreed is that is 60 days. So within 60 days, if you apply the quick refund procedure, the taxpayer should get the refund. What is very interesting to note, and I said that as a teaser in the beginning, is that in this Foster proposal, reference is made to the UNSHL directive. So there it has been made quite clear that UNSHL is definitely on the table, and that it is expected, or at least I expect, that we will hear something new on that soon, and that UNSHL will proceed, contrary to some other opinions in tax literature. And also, the date of enter into force has been extended. So Foster, if and when adopted, will apply as per 2030. So interesting.
Which is interesting, and you're wondering, is that giving them time to get on Shell? You know, obviously, we've said there's been successive drafts of that. We know it's sitting somewhere, but obviously hasn't moved forward. That time frame is interesting, that we're now talking about implementing proposals that are going to be effective from 2030.
Yeah.
Which is a long, long way away. The world is changing quite quickly, as is tax.
Yeah.
So just moving on, the EU Commission have been quite a proponent of HOT, which kind of came out with the BEFIT proposals back in September last year that we talked about previously. And also there's been quite a lot of commentary around the transfer pricing proposal at an EU level that was also issued last September. Where are we on both of those 2 initiatives?
Yeah. So first on HOT, yet another abbreviation. So HOT stands for Head Office Taxation. And it really tries to simplify and make it less burdensome for small and medium-sized entities to file corporate income tax returns. So currently, let's say you're a European head office and you have various permanent establishments across Europe, then you do not only need to file a corporate income tax return of the parent company, but also for the various branches you have in the European entities, which is costly, time-consuming, burdensome. In HOT, only the parent entity files the corporate income tax return, collects the taxes in conformity with the applicable tax rates in those jurisdictions, and then distributes the collected taxes to these various subsidiaries. There's been some debate as to whether the scope of HOT is sufficient enough. And interesting to note is there has been a recent amendment suggesting that it is extended to subsidiaries as well, with a maximum of 2. So one head office with 2 subsidiaries will also fall under the scope of HOT. What has also been amended is that the date of enter into force has been removed to 2025. And that is, to me, quite ambitious, because as it wasn't on the agenda of the May meeting, and we now have these re-elections, I highly doubt whether 2025 is feasible, taking into account that for Foster, they went for 2030. But man,
interested to get that one, and that they've put some focus on that to get that over the line, which is interesting.
Yeah.
Transfer pricing proposal, what are the views on that across the EU?
Yeah. So we already had, of course, the BFIT proposal replacing the CCTB and the CCP, which have been withdrawn, basically introducing a new set of rules to calculate the tax base, consolidating that, and then reallocating the tax base to the various European countries. And alongside this proposal, we have a TP directive proposed. And the basic of this TP directive is to implement the arm's length principle and the TP guidelines in the EU legislation. And it furthermore introduces rules to determine which TP method should be used. It clarifies the role of the TP guidelines because there was quite some confusion between, or not confusion, but the different interpretations between the 27 member states with respect to those OECD guidelines. And it also introduces mandatory TP documentation requirements. And if this TP directive meets the finish line and it is set for 2026, then this might have a significant impact on EU multinational enterprises operating in various EU companies, as it introduced basically a complete new set of rules. But it's also still debatable as to whether it will make the finish line, because it's expected that not all 27 member states will feel the same on harmonization of those TP rules.
And TP is really a global concept, consistency based on OECD guidelines, and we're now potentially moving away from that at a European level, all bet for certain transactions. So, really the alignment of that is really a concern, isn't it?
Yeah, definitely is. So it's also close to watch. So those three basically intertwined. So HOT, BFIT, and the TP directive. Yeah. And personally, my thoughts are also that they are closely looking what will happen with Pillar 2 and how that has been adopted in the various member states. But that's my personal opinion.
And look, while it's effective from this year in all the member states, we're probably not going to see the impact of that until filing starts in 2026.
Yeah, agree. Yeah. Sasha, also one final question to you. So last week, the European Commission also opened a new consultation on the effectiveness, efficiency, and of course also relevancy of the various DACs, DAC 1 to 6 and DAC 6 being the mandatory disclosure rules. What are your thoughts on this?
So a review is automatically enshrined in the DAC legislation, and that every 5 years there'll be a review. So this consultation period covers the period from 18 to 22, so hence covers DAC 1 to DAC 6 as part of that review process. Interestingly, there was a report issued in 2022, and there were some challenges around how the DACs have been implemented consistently in different member states, and that some of the definitions are quite broad within the directive themselves, and when implemented in member states is allowing for an element of openness as to how that's interpreted and how that's implemented based on national law. And we as advisors have probably really seen that when we look at DAC 6 and how that's implemented and the various different views across member states when we're trying to do cross-border reporting. That has been challenging in certain instances. So you've also had DAC 6 challenged by a group of Belgian lawyers as to whether it was unlawful. And that was reported on by the AG at an ECJ basis to say that ultimately they felt that while the DAC 6 was quite broad, it was reasonable as an overall concept. So we're seeing some, again, of these broad language terms being really challenged. And I suppose the main thing about the DACs is it facilitates the exchange of information by tax authorities cross-border. And there obviously needs to be clarity as to what's in that and that it's consistently interpreted across member states as to what information is being shared. The consultation period is open until July. So I think it's really, really interesting to see what feedback comes out of that. Because, we're seeing more and more DACs issue. We know there's a DAC 7 for online platforms. There's a DAC 8 now for cryptocurrency. And we're hearing that there's going to be a DAC 9 in relation to how member states are going to share information around Pillar 2. So this process has been adopted at an EU level to exchange this information, I think has to be robust and there has to be some consistency.
So lots to consider there. And with the new re-elections coming up in July and also the Hungarian presidency, it's important to keep a close watch of all these topics we just addressed And there are even some topics on the table which we didn't discuss. So our recommendation to multinationals is really keep a close watch. And if you have any questions on these proposals, feel free to contact Sasha, me, or one of our other Grant Thornton international colleagues. And also, I would recommend to watch our biannual newsletter, which we issue and which you can find on our website and on our LinkedIn. I thank you on behalf of Sasha and me for watching, and till the next one.